Hey, welcome to the Core Curriculum Podcast. My name is Crawford Anderson. I'm the founder of AWM Financial, a platform for young adults and students focusing on financial education and literacy. I write a weekly personal finance column for the Niner Times, and I'm here with my co-host today, Thomas Wong.
Hey, I'm Thomas Wong. Me and Crawford met through the investment club. I'm a double major in finance and statistics at UNC Charlotte. And general interest in finance.
You're in the right place. I'm a junior in finance, concentration in finance and accounting. If you can't tell, I like finance. But today we're going to be talking about the first article in the Core Curriculum series called From Coffee Money to 1.5 Million.
Yeah, what does it cover? Just
broad overview. We're going to talk about the power of investing over the long run, how just a little bit of money can build your financial freedom and future, and how setting a proper foundation when you're a young person like us, I think we're both 19, right?
Yep.
Setting a proper foundation now sets you up for the long run.
Okay, so for everybody out there, I'll ask the question, what is investing?
So investing is the process of taking your money, also known as capital, and giving it to a business or a company to go and make money for you. So let's take an example of a lemonade stand. We're out in here in the student union. Let's say you wanted to set up a lemonade shop outside. You know, you see the carts of food, the food trucks outside. Let's say you want to start Thomas's Wonderful Lemonade.
Yeah.
Let's say you need $100 to start that up. Well, you don't have $100 in this scenario. Sorry, You're broke. But I do have $100, and you need money to go get lemons, sugar, ice, cups, a tablecloth, a table, whatever you might need for your business, maybe a poster. And so I give you $100. And because it's your idea, you're doing the work, you're doing the effort, but I have the money, we're going to split the business 50-50. So I'm going to have 50% ownership, and you're going to have 50% ownership in Thomas's Wonderful Lemonade Incorporated.
Yeah.
So you're going to take my money, you're going to go buy whatever you need. Let's say you go over to Harris Teeter and you get your lemons and your sugar and all that good stuff, and you go and sell your cups. And maybe you sell $10 one day, $20 the next day. The specific numbers doesn't really matter, but once you've paid for your expenses, so like your cups, maybe if you have an employee or something like that, whatever profits that you have, we split equally. So let's say you make $20 in a week, I keep 10 and you keep 10.
Yeah, so I hear you out.
Sure.
But why shouldn't I download something like DraftKings and put all my money on the Lakers to win the next championship? You know?
That's a great idea, and unless you have some inside info, in which case that'd be illegal. But otherwise, you don't really know what you're betting on, right? You are just throwing darts at a wall blindfolded. When you're gambling, let's say it's whether or not it's a scratch-off ticket, a lottery ticket, sports betting, or even in today's prediction markets where you're betting on the weather or whatever the heck else is going on over there, you can't control any of those things. What I can control as an investor is what company I invest in, and I can do research on those companies, on Thomas's Lemonade Stand, or on whatever company I'd like to invest in to go see, is the management, is the CEO a good CEO? Is he going to do a good job leading? Is the product good? Is the service good? And does that company have revenue and a good business model so that they generate profits, also known as earnings, for me as an owner? Great example of this is we're on campus, right? There's 6,000 students who live on campus. I can go in and ask them what drinks they prefer. And let's say 3,000 of them say, I like lemonade more than Coca-Cola. Well, that's really good information for me as an owner. It makes me want to invest in your business. Let's say they say, I really like Thomas's lemonade more than Crawford's lemonade. Yeah. I might be a little bummed out, but that means I really, really want to invest in your business because I can go and take that data to make an informed investing decision.
Yeah, as they should. They should like my lemonade a little bit more than yours.
You stacked it with sugar?
It got love. So say I say, I'm going to take all my money out. I'm never going to sports bet again. Where do I put my money, though? What is a way from somebody who doesn't know how to put money into the stock market to get some kind of growth going?
Right. So a growth or a return, just getting profits on your money, it's very hard to pick individual companies. In fact, most people shouldn't even try because unless you know everything about the business, then you are basically gambling, right? Because that's the difference between gambling and investing is that you can understand the business behind your investment, and with gambling you don't. But if you're randomly buying individual companies, then you are basically gambling if you don't know all the information behind them. And most companies are very large, and there's lots of information to know about them, and it usually takes dozens of hours of research to try to understand it, which is why we do something called indexing, and I believe we both participate in this.
Yeah.
indexing is the process of owning many companies all at once. We're going to use 500 because that's the most famous. It's called the S&P 500, and that is an index that tracks the largest 500 U.S.-based companies. So they're located here in the U.S., not in Britain or Europe or wherever. They're based here, and they're profitable, and they're publicly owned, which means that they trade on the stock market in New York, and anybody with money can go and buy shares in them. We're going to use Apple today as our example.
Yeah.
But basically, me, your grandma, my grandma, your grandma's friend, Gertrude.
God bless her.
God bless her. She can go buy some Apple. She might not know how to use her iPhone, but she can own a piece of the company. So it's really an incredible tool. It's called diversification.
Yeah.
Because if I can't spend 25 hours a day researching a company, which is what it usually requires to be able to do in-depth individual company analysis to decide if I want to invest in it, you can own 500 companies and own a little slice of each one. And that way you don't have to worry about picking the next big one. You don't have to pick the next Apple. And some of those companies might do poorly. I'll use Walgreens as an example. They've been doing poorly recently because people don't want to go to Walgreens. Just get it delivered by Amazon. Who cares? If you don't have to own all the best companies because you already do when you're indexing. So you don't have to pick the right ones. You just own a little slice in a lot of them, and some will do better and some will do worse, but overall you'll do pretty good.
Okay, so we go from something like the S&P 500, and I hear what you're saying about the S&P 500, the biggest 500 companies.
Let me expand on that. The S&P 500 is one metric and basically one number that tracks all 500. So it's possible to buy one share in it, and you don't have to go worry about buying 500 companies. Yeah. Because I know that sounds crazy, right?
So you get a little piece of every company.
Yeah, and somebody else goes and does it for you. So I don't even have to worry about it.
Yeah. So say I'm like, yeah, Crawford, I'm going to buy the S&P 500. But what do I expect? What can I expect for this for 20 years, and what can I expect next year?
Right. That's a really good question because when most people think about saving money, they think about maybe their Bank of America checking account or their savings account. Maybe you get a few cents in interest a year. I know I've seen that little slip of paper that says 9 cents in interest and things.
Yeah, from $3,000.
Yeah,
it's like, how is that possible?
That was useful, right?
Yeah.
That's great. I can go buy nothing. Yeah. With investing, you have much better returns typically. Over the last century and even longer, the S&P 500 has averaged about 8 to 10% a year in returns each year. Now, that doesn't happen every year, right? Some years are better than others. So some years the companies are making more profits and their share price is going up because they're worth more. Now, some years things are going worse. So the most recent example of this would be 2020 during the pandemic.
Yeah.
If you're an investor, there's no future to invest in, right? You think COVID's going to take over the world. Share prices performed very badly. Stocks did very badly. And so that's why it's important to invest over the long term, because our world is very volatile. There's wars, there's geopolitical issues, there's plenty of things that are going on all the time. And so from one year to the next, it's very hard to predict what's going to happen. But the longer you spread out your investments, from 1 year to 5 years to 10 years and beyond, the higher the chance that you have a overall return that is positive. So from 5 years, I'd say there's maybe a 20% chance you lose money, historically speaking. But when you go out to 10 years, there's only been one period historically, and that was the Great Depression, where you lost money over 10 years. And after you go out to 20 years, there's never been a historical instance of you losing money over that time frame. And since we're both 19, we'll call it 20. We'll round a little bit. Let's say we want to have our money when we're 60 so we can retire. Go live out our days on a beach yacht in Naples, Italy, or whatever.
Yeah.
Over 40 years, historically, your money will grow at 10% each year, and you almost certainly won't lose money. Although it's not possible to predict the future, we can take a lot of our historical data and get a rough outline of what we can kind of expect.
Yeah, so I'm investing in the S&P 500 not for next week or next year probably.
Absolutely, yeah.
We're investing for, 50 years. We're investing for almost me paying for my grandkids, something like that.
Yeah, and although everyone's financial situation is different, and you should, do your own research on your own personalized investing goals, in my view and in my investments, anything over 5 years of a 5-year period where you're ready to lock up your money, for lack of a better term, is a good amount of time to start investing. Anything, a year or less is when you start getting into riskier territory because you can't predict what's going to happen tomorrow in the stock market.
Yeah, and that's something you get into in your article about the power of compound interest. And I would like you, since you wrote the article,
yes,
to go explain this phenomenon.
Yeah, so compounding is a really it's known as the eighth wonder of the world. And we'll have a graphic to go along with this, but basically over time your money grows on itself. So if you have $100 invested in your lemonade stand, let's say the first year you get that 10% average return. So you grow the business, you get $10 of profits, which we also call earnings, and now your business is worth $110. The next year, let's say you get another 10%, which again is the historical average, you will have 110 plus 11, so 121. And we don't have to get into the weeds of all the specific numbers, but over time, it's going to compound to the point where it's growing faster than you can even take your income and invest.
Like a snowball effect.
Like a snowball effect, exactly. So we'll have the graphic on screen, but $1 at age 20 invested for the long run can turn into over $50, and then invest in certain things even $75 or even more because of the power of compounding. So $1 even grows into significantly more by the time you retire.
Yeah, and it's important to point out it does grow, but it needs a specific time to grow. If, say, for instance, I'm investing $1 compared to, Grandma Gertrude investing that same $1.
Yeah, absolutely.
I'm not saying Grandma Gertrude got less time, but she has a little bit less time than me.
Absolutely, absolutely. And that is something you have to factor into your decision-making process. So, again, it's going back to the 1 year, the 5 year, the 10-year time horizon. If you look at the compounding chart, over time, the first 10 years are the slowest because that's when your money hasn't had a lot of time to grow on itself yet.
Yeah.
But over time, your money will start snowballing even more and more and more to the point where it's growing extremely rapidly. And that typically happens around the 10-year mark on your investing journey.
Yeah, so a good rule of thumb is 10 years, or what, in your opinion, would be a good, time frame to look at?
This is when we're getting into opinion and not necessarily verifiable data. But generally speaking, the 10 to 15-year mark is when you're going to start to see the total return on your investments start growing pretty rapidly. Yeah. So instead of it being, on $100, it being $1 per year, now it's maybe $15 a year, $10 a year, somewhere in there, to the point where it's really rapidly growing. And then when you get to 20 years or 30 years, so that would be when we're age 40 or 50, that's when you're really seeing your money grow faster than your income. You can stop working for money and start letting your money work for you.
Yeah, so would it be a hard statement to say investing earlier is better?
No, that's the easiest thing to say, is because the power of compounding is time. Starting as young as possible is super important because time is the only asset we can't get more of, right? You can't be 19 again, you can't be 20 again. The earlier you start, the more time your money has to grow and compound. And starting at age 20 means that you get 40 plus years of your money working for you so that you can retire or reach whatever other financial goals that you have.
Yeah, and back to the title, that just shows the power of compound interest.
Yeah, absolutely. And we'll run over a brief example, but $25 a week, so skipping your daily, mochaccino, mochaccano, whatever it's called. I don't know, I drink it black anyway. So $25 a week grown at 10% a year, which is, again, the average historical return, from age 20 to age 60 grows to $634,000 from $25 a week. And that amounts to you contributing just over $50,000. A lot of money, but $630,000 is a lot more than 50.
Yeah.
And then if we go to even 50 years, so age 20 to age 70, you're a little bit deeper into retirement.
Yeah.
Maybe you're willing to pay for your kids' education or their schooling or whatever other goals that you have. That grows to over $1.5 million at $25 a week. And that's from you only contributing $65,000.
Yeah, it's kind of incredible,
It is absolutely incredible. And that's $25 a week. That's one or two, shifts, not even shifts, 1 or 2 hours of working.
Yeah, I know how I waste. How I waste $25 a week.
Yeah.
And it grows. And rule $25 becomes what over a time frame?
So at 40 years, you're going to end up around $635,000. And again, these are just rough projections, of course. Things change, fluctuations, but this is a rough idea, given the 10% average return. historically, and at 50 years, it turns into $1.5 million. Over 1.5 million, actually.
That's incredible. Yeah.
Yeah, and that's the power of waiting and allowing your money to grow on itself. Most people think that you have to have a lot of money and knowledge to get started investing. That's not true. You don't have to be a Patagonia-wearing finance bro on Wall Street eating a $30 bowl of kava to start investing. You can literally start with $1.
Yeah, and you're investing in something that's, I mean, if you pick the S&P 500, that's diversified.
Yep, that means you get to own 500 different companies. Yeah. In fact, we could list them all for the next 30 minutes of all the companies that we both own.
Yeah.
Companies that we all use every day, from Apple, Google, Amazon, Microsoft, Walmart, Coca-Cola. Those companies are working to make me money as we speak.
Yeah, and you don't need any expertise. You don't need to do anything.
Nope.
You know,
just this 20-minute podcast alone is enough time for you to get the basic knowledge of investing.
Yeah. So, I guess looking forward to next week, what should we look forward to?
So we're going to talk about how the sausage gets made, how the S&P 500 really works, going a little bit more in the nitty-gritty of it, not getting too deep in the weeds, but giving you more context on what diversification actually means and how the biggest companies actually impact the index and how they make money, so that you can have a better grasp of how your money is working for you.
And it's important to say that while, yes, we use this article as a template, the article goes into more depth.
It does. It does. It's really the spine of our conversation.
Yeah.
But if you want more information, more specific numbers and analysis, go check out the article that'll be linked in the show notes, or go to awmfinancial.net for more information.
All right. Thank you.
Absolutely. Have a good week.